Hey, good morning. This is Mayor Valensky with Driving Markets, driving while talking about markets. Remember, anything said in this piece is an opinion only. Okay, so today we've got Kevin McCarthy, Speaker of the House, meeting again with Joe Biden and his team to try and get a solution to the debt ceiling. I personally cannot believe that the US is going to default. So my opinion is very clearly that either today or this week, before the deadline, they'll reach an agreement. I just can't accept and can't fathom that there's going to be a default in the US, because that will cause real effects, a ripple effect across equity markets and obviously amongst currency markets and even commodity markets, including bonds, etc., etc. So they're meeting today. They probably won't have an agreement today, but they'll be advancing the talks. Remember, there is a real tear between the left Democrats and the Republicans. Now, the Democrats, which is led by Joe Biden, who most of the time is not conscious and not awake, wanders around lost on the stage. That's the local stage and the global stage. At the moment is at the G7 meeting in Japan. The G7 meeting used to be called the G8 meeting until they kicked out Russia because of its invasion to Ukraine. So it's the G7 meeting there, and there they're discussing all of the economics, inflation, interest rates, and obviously there'll be other topics that they'll raise. Now, this week you've got Jerome Powell, or more effectively, you've got the minutes of the last FOMC meeting. No doubt they will indicate that the Fed has come to the end of its interest rate cycle. The chance of a next interest rate rise is up at about 30%, so it's pretty low. I don't believe there's going to be an interest rate rise in June. I think more or less we've come to the end of it, simply because the US economy and obviously global economies, but the US economy, I think, is unable to absorb any more interest rate rises. If you want my real gut feeling, what they should do is they should raise rates to round about 5.5%, and then call it a day, and that will probably have its impact. But as commercial property falls due to violence, drug-related crime, and companies just abandoning or walking away from big industrial estates or buildings or shops, then that commercial drop in property is going to impact obviously on regional banks, which have already had trouble this year, and that trouble is going to continue because they're the biggest lenders to the property sector, whether it's retail or commercial. Going back to the minutes of the FOMC meeting, so those minutes will be an indicator as to what the Fed thought about interest rates. In addition to that, you've got the preferred inflation gauge of the Fed this week, which is the PCE, personal consumption expenditure, and that will give the Fed a clear indicator of where inflation is at. Now, if that number comes in obviously higher than expected, that is going to concern investors, traders, and analysts. And in addition to that, it's going to put more pressure on the Fed to potentially raise rates. So if that PCE comes in higher, then you could expect the probability of an interest rate rise in June to jump from 30% to around about 40 or maybe 50%. All depends what the PCE is. In addition to that, you've got the University of Michigan sentiment report out this week, which is also an indicator of where consumers are at and overall the sentiment in the economy. Now remember, I did mention on my YouTube channel and on Instagram that the US Americans are now buying more gold than ever as a hedge to where the economy is going. If we go back to the 1970s where there was stagflation, gold increased 16-fold. I don't think it's going to increase 16-fold now. I mean, it's already gone up to nearly $2,000 at $1,977, but it will go up if there is stagflation or if there is concern by the consumer, whether it's in the States or whether it's in Europe or the UK, that there's going to be a problem with the economy or with government authority or with just government practices, which would cause instability. Other thing to look at, as I mentioned previously, also was Bitcoin. Bitcoin now, again, crypto is very binary, all right? It's very binary. It's very just up or down. There's no real fundamentals. But as someone mentioned, as Bitcoin has got limited number of coins out there, it could have intrinsic value. overall, expect the markets to be a little bit unsteady this week as far as the because of the debt ceiling talks. Until they're clarified, no one's going to know which direction we're going in. If the debt ceiling is raised and agreement is finalised, then you'll have a relief rally as far as markets are concerned, and then what they'll probably do is be sold off. The markets are looking a little bit toppy at these levels, in my opinion. Also, there was a report out that AIGBT will now is so valuable that could cause the next bull market as far as equities are concerned. However, the equity markets are split between the high tech and the regular everyday businesses. The everyday businesses are not going to jump up as fast as high tech if really this AIGBT is supposed to be, as it turns out to be, what it is supposed to be, which is artificial intelligence input by a lot of people around the world to create this facility where you can get what you want at a moment's notice, or just by pushing a few buttons. Anyhow, interesting week ahead. You can subscribe, share, comment. Look forward to hearing whatever you have to say. This is Mayor Walensky with Driving Markets. Have a good day.